trust funds, escrow, and commingling risk. Finally, handling other people's money is one of the most serious areas of risk in real estate. Trust funds include earnest money, security deposits, and other monies held on behalf of clients and customers. Most states require these funds to be deposited into special trust or escrow accounts that are separate from the brokerage's operating funds. Typical requirements include naming the broker as trustee on the account, using a recognized financial institution, keeping detailed records of all deposits and withdrawals, maintaining separate records for each transaction or beneficiary, and reconciling the records with bank statements regularly. Only the broker or specifically authorized individuals may withdraw funds, and disbursements must follow the terms of the contract and state law. Commingling means mixing client funds with personal or company funds. Conversion means using client funds for personal or company purposes. Both are among the most serious violations in real estate. Even temporarily borrowing client funds or leaving your commission in the trust account longer than allowed can be treated as commingling. The safest practice is to handle all trust funds strictly according to law. Deposit them quickly, disperse them only with proper authorization, and remove earned commissions promptly and properly. Review, summary, what you learned about primary areas of risk. In this section, you saw how risk moves from theory to practice. Agency relationships create ongoing duties of loyalty, obedience, confidentiality, accounting, care, and disclosure. Conflicts of interest arise when your financial interests or personal relationships clash with client interests, and you must disclose and manage those conflicts. Confidentiality extends beyond closing and applies to personal and financial information as well as motivations. You learned that property condition and hazard disclosures are a major risk area, with specific requirements such as lead-based paint disclosures for older homes. Listing and selling risk revolves around accurate agreements, careful pricing, and honest communication, supported by written documentation. Advertising and permissions must comply with fair housing and license law, avoiding misleading claims and discriminatory language. You saw that your scope of expertise matters. Stepping into legal or technical roles without proper training creates unauthorized practice of law and misrepresentation risks. Contracts must be accurate, complete, and timely, with clear inclusions, exclusions, and contingency tracking. Misrepresentation, whether unintentional or intentional, can lead to discipline, damages, or even criminal liability. You also explored fair housing risk, antitrust risk, and the consequences of violating rules and regulations. Financing, appraisal, re-SBA, and closing risk all emphasize the importance of explaining the process, setting realistic expectations, and documenting your advice. Finally, you learned that mishandling trust funds or commingling client money with personal funds is among the most serious mistakes a licensee can make. Discussion. A buyer asks you, "Is this neighborhood safe? I don't want to live near any certain types of people." How should you respond in a way that reduces risk and complies with fair housing principles? Suggested answer: you should avoid commenting on crime, demographics, or types of people. Explain that fair housing laws prohibit you from discussing neighborhood characteristics related to protected classes. Instead, suggest that the buyer review police crime statistics, school websites, or demographic information from independent public sources. Focus your discussions on the property's features, price, condition, and location in neutral terms. This approach reduces the risk of a steering or discrimination claim and reinforces your role as a housing professional, not a social gatekeeper. Your seller wants to list their property at a price that is significantly higher than your recommended comparative market analysis range. They insist that someone will pay it, and they want to test the market. What is the best risk management approach for you? Suggested answer: prepare a clear comparative market analysis, explain the data, and document your recommended pricing range. Make sure the seller understands and acknowledges your recommendation in writing. If you decide to accept the listing at their higher price, note in your file that the price was set at the seller's direction against your advice. Continue to provide market feedback and recommend price adjustments as needed. This documentation helps protect you later if the property fails to sell or appraises low, and the seller blames you for pricing problems. A first-time buyer tells you they are confused about all the fees on their loan estimate and asks you, "Is this a good loan? Should I go with this lender?" How can you help while staying within your scope of expertise and avoiding unauthorized practice of law or lending advice? Suggested answer. You can explain in general terms what different categories of fees represent, such as origination charges, points, prepaid interest, and escrows. You can encourage the buyer to compare total costs and APRs when shopping lenders. However, you should avoid telling them which specific loan or lender to choose. Instead, recommend that they speak directly with the loan officer and, if appropriate, consult a financial advisor or attorney. Clarify that you are providing general information, not specific financial or legal advice. Document that you referred them to appropriate professionals. Your broker allows you to recommend inspectors and other vendors, and you have a few you use regularly. One inspector you like sends you gift cards every holiday season to show appreciation for your referrals. What are the risks here, and how should you respond? Suggested answer. Accepting things of value for referrals can raise RESPA concerns if the inspector's services are part of a federally related settlement service, and it can also create perceived or actual conflicts of interest. A buyer might claim that you recommended the inspector for personal benefit rather than professional judgment. The safest response is to inform the inspector that you cannot accept gifts tied to referrals and to return or decline them. Consider providing multiple inspector options to clients and documenting that they are free to choose anyone, including providers not on your list. Disclose any business relationships in writing if they exist. Closing remarks. Primary risk areas in real estate are not mysterious. They show up in exactly the places you spend most of your working life: agency relationships, disclosures, offers and contracts, marketing, financing, and handling money. The difference between a low-risk and high-risk practice is not that one avoids all difficult situations while the other does not. It is that the low-risk practitioner has systems, training, documentation, and ethical habits that guide decisions in those situations. As you move forward in your real estate career, keep tying these risk areas back to the tools from earlier in the chapter. Use education to avoid mistakes. Use documentation and standard forms to prove what happened. Use insurance and proper business structures to transfer and contain risk. Use honest communication and realistic expectations to prevent anger and surprise. Above all, remember that your license, your reputation, and your client's trust are your most valuable assets. Good risk management protects all three.